5 ways to trading earnings. Earnings trading is the practice of buying or selling stocks based on a company's earnings report. The goal is to take advantage of the price movements that occur due to surprises, whether positive or negative, in a company's earnings. Traders analyze earnings reports, revenue growth, profit margins, and forward guidance to anticipate how the market will react. Earnings reports are quarterly financial statements issued by publicly traded companies. These reports disclose key information such as the company's revenue, net income, earnings per share, and other financial metrics. The 3 most critical parts of an earnings report include revenue. This indicates how much money the company made over the quarter. Net income. This shows the profit after all expenses have been deducted from revenues. Earnings per share. This metric is especially important for shareholders because it divides the net income by the number of outstanding shares, giving a per-share figure. Earnings reports are compared to analysts' expectations, which helps drive stock price reactions. If a company beats or exceeds expectations, its stock may rally, while a miss could lead to a sharp sell-off. However, the market's reaction is not always straightforward, which adds to the complexity of trading earnings. Earnings season occurs 4 times a year, generally a few weeks after the end of each fiscal quarter. This period is eagerly awaited by traders, as companies reveal their financial health and future outlook. The earnings season can lead to significant volatility in individual stocks as well as broader market indices, like the S&P 500 or Nasdaq. Several factors make earnings season so important. Transparency. Companies disclose their latest financials, providing transparency and an updated view of their operations and performance. Market movement. Earnings results often lead to large swings in stock prices, providing opportunities for traders to profit from volatility. Forward guidance. Companies often provide forward guidance during earnings reports, outlining their expectations for the future. This guidance can significantly impact how the market values a company. Trading around earnings announcements requires a specific set of strategies and careful planning due to the unpredictable nature of the market's reaction. Here are some approaches that traders can use. 1. Pre-earnings anticipation trade. The anticipation trade involves entering a position ahead of the earnings announcement, with the expectation that the stock will move in a particular direction based on pre-earnings sentiment. This is often fueled by speculation, news flow, or insider sentiment. Advantages. You can take advantage of the run-up in stock price before the announcement. If the market is bullish on a stock and expects good results, buying ahead of the announcement can lead to gains. Disadvantages. If the actual earnings report disappoints, the stock could drop sharply, leaving traders exposed to significant losses. To mitigate risks, traders may use options, like calls and puts, or diversify across multiple earnings trades. 2. Post-earnings reaction trade. Once the earnings announcement has been made, traders look to capitalize on the immediate market reaction. The post-earnings reaction trade is based on how the stock responds to the earnings news. Advantages. By waiting until after the earnings report, you have the advantage of clear information about the company's performance, making it easier to assess the next move. Disadvantages. Stocks can still be highly volatile post-earnings, and the market can react unpredictably, even if the earnings report appears positive or negative at first glance. This strategy is useful for those who prefer to wait for the dust to settle before making a move, often taking advantage of gaps in the stock price. 3. Straddle or strangle options strategy. Options traders often use the straddle or strangle strategy during earnings season to benefit from the large price swings that accompany an earnings announcement, regardless of the direction. Straddle. In this strategy, the trader buys both a call option, expecting the stock to go up, and a put option, expecting the stock to go down, with the same expiration date and strike price. This strategy profits if the stock moves significantly, whether up or down. Strangle. Similar to a straddle, but with different strike prices for the call and put options. A strangle is cheaper to implement but requires an even larger price move to be profitable. Advantages. You don't need to predict the direction of the stock's movement, just that it will move significantly. Disadvantages. Both strategies require a large enough move in the stock price to offset the cost of purchasing the options. If the stock doesn't move much, you could lose the premium paid for the options. 4. Day trading around earnings. For more short-term focused traders, day trading around earnings releases can be a lucrative strategy. It involves taking advantage of the rapid price movements that typically follow an earnings announcement. Advantages. The volatility immediately following an earnings report can create numerous trading opportunities. By focusing on short-term moves, traders can profit multiple times during the day. Disadvantages. Day trading earnings requires intense focus and quick decision-making. The volatility can also work against the trader, leading to potential losses if positions are mistimed. 5. Earnings momentum trade. The earnings momentum trade is a medium-term strategy where traders capitalize on the market's ongoing reaction to positive or negative earnings surprises. Advantages. Stocks that experience strong earnings growth often enter a prolonged period of momentum, allowing traders to ride the trend for several days or even weeks. Disadvantages. Momentum can reverse quickly if market sentiment shifts, and poor earnings guidance or macroeconomic events could derail the trend. While earnings reports contain a lot of information, not all data points are equally important. Here are the most crucial factors to consider when trading around earnings announcements. Earnings surprises. An earnings surprise occurs when a company's reported earnings are significantly above or below analysts' expectations. Positive earnings surprises often lead to upward stock price movements, while negative surprises can result in sharp sell-offs. Revenue growth. The market values companies that consistently grow their revenue. Watch for year-over-year revenue growth, as this metric shows how much a company's sales are increasing. Margins. Gross margins, operating margins, and profit margins are essential indicators of a company's efficiency and profitability. A company may beat revenue expectations but still underperform if its profit margins are shrinking. Forward guidance. Many companies provide guidance on expected future earnings and revenue. Forward guidance can have a more significant impact on stock prices than past performance, as it reflects the company's future outlook. Sector trends. Individual company earnings can be influenced by broader trends within their sector. For example, if a technology company reports strong earnings, other tech stocks might also rally in anticipation of similar results. While trading earnings offers significant profit potential, it also comes with heightened risks. Some of the primary risks include volatility. Stocks can experience extreme price swings in reaction to earnings, making it easy to incur large losses if trades go wrong. Unexpected market reactions. Sometimes, even positive earnings results can lead to a stock's decline if the market expected even better performance or is disappointed by future guidance. Gaps. Earnings releases often cause stocks to gap up or down at market open, meaning the stock opens at a significantly different price than the previous day's close. This can make it difficult to execute trades at desired prices. Liquidity issues. Some stocks may experience reduced liquidity around earnings, making it harder to enter or exit trades at the desired price. Emotional trading. Trading earnings can be exciting, but it's essential to remain disciplined and avoid letting emotions dictate decisions, especially when facing rapid price changes. Conclusion. Trading earnings can be an exciting and profitable strategy, but it requires careful planning, disciplined execution, and a strong understanding of both technical and fundamental factors. By using strategies like anticipation trades, options straddles, and post-earnings momentum plays, traders can navigate the earnings season with confidence. However, they must also be aware of the risks involved and employ risk management techniques to protect their capital. Whether you're a day trader looking to capitalize on volatility or a longer-term investor seeking to refine your entry and exit points, trading earnings can be a valuable addition to your trading toolkit. But as always, due diligence, research, and strategy are essential to achieving success in the markets. Thank you for watching.